All right, welcome back to the program. Kenneth Erikume is joining me right now. He's a tax partner, tax reporting and strategy at PwC. Hello, Kenneth. Good morning to you.
Hello, Nancy. Good morning. How are
Hi,
you?
I'm well, I'm good. How are you doing today?
I'm very well, thank you. Thanks for inviting me to your program.
You're welcome. Now let's get started. I did say earlier when I was introducing this interview for today, talking about this 2021 finance bill, giving kudos to the federal government so far for its consistency in transmitting finance bills since 2019. You will recall that we've not had it in years, perhaps over 20 years or so. Finance bill that accompanies an appropriation bill. What would you say about the consistency of government, at least since 2019? And do you think that the objectives of the finance bill since 2019 has been met so far?
Yeah, so I think obviously the improvement in the process of looking at the fiscals, how revenue is generated, and how it's applied on an annual basis is a welcome development. And that consistency over the past 3 years is actually commendable because it's one thing to start that process, it's another thing to sustain it. So from the perspective of the government, they've done very well. In actually meeting the objectives, I would say, to a large extent, that process has been able to meet the objectives. Because one of the things it does is that it tries to marry the budget with how, the revenue would be generated in order to drive that budget. So the finance bill as a component or an enabler of the budget is, fulfilling that obligation. It has actually done that. It has also introduced a lot of changes in the tax system because our tax laws have been very old. Many of them are old and have not been brought up to date. So that process of looking at, the trends and the changes in time, and also dealing with that in the tax law, it's also achieving that objective. There are other objectives in terms of tax administration, improving the tax administration or strengthening tax administration, that I think it is still at the elementary phases of achieving those objectives. However, in terms of revenue generation, in terms of fiscal responsibility, and a lot of other issues, I think it has achieved some of those objectives.
Now let's stick a bit with the objectives before we go into the nitty-gritty of this 2021 finance bill. One of the objectives is supporting MSMEs. Do you think that it has significantly done this since 2019? Another objective could be that of promoting fiscal equity. Has it done that? Another objective that I also know about the finance bill should be raising revenue for government. Since 2019 till date, do you think that the finance bills that we've seen as passed and assigned by Mr. President has done these three: supporting MSMEs, promoting fiscal equity, and also raising revenues for government?
Okay, so the first one in supporting, micro, small, and medium enterprises, I think Finance Bill 2019 and 2020 achieved that objective. One of the things, or some of the things that were introduced in the past couple of years is, number one, a total exemption from company income tax for small companies. Small companies as defined as companies that have an annual turnover of 25 million and below. So Finance Act in the past couple of years exempted those companies from companies income tax, as well as from VAT. So for companies whose annual turnover is less, or businesses generally, where the annual turnover is less than 25 million, they're exempted from the penalties from non-registration, charging, or filing VAT. So to that extent, a small salon on the wayside, or a shoemaker on the roadside, who's making less than 25 million naira on an annual basis, they do not have to register for VAT or charge VAT on their supplies to customers. So to that extent, I believe it's met the objectives for, or at least to a large extent, met the objectives for small companies. It also introduced a 20% tax rate, so it cut the tax rate from 30% to 20% for medium-sized companies, for companies' income tax. And those would be companies with revenue of less than 200 million, but above 25 million. So those group of companies also benefit from a reduced tax rate. In the current finance bill, which has been put before the National Assembly, there are not many innovations or support to small, micro, and medium enterprises. In fact, some of the proposals, such as the fact that they will lose capital allowances, which they have not utilized when they move from a small company to a larger company, could actually be considered by some to be a disincentive. So I think, but when you look at everything together, I think the finance bill process has supported small, micro, and medium enterprises. On the second issue of whether it has improved equity, one of the ways you improve equity in the tax system is to ensure that the economic viability of a business is also reflected in its taxation. And to do that, the tax laws have to be progressive. And last year, Finance Bill, Finance Act, there were introductions that many people embraced and celebrated as providing equity in the system. And one of it was the reduction in minimum tax rate from 0.5% to 0.25% for 2 years of assessment. And many people in the tax space consider that to be very, very important. And the reason why it's important is because a company who is loss-making or who is making limited margins, the minimum tax imposes an obligation for them to pay tax anyway. So it essentially means they have to eat into their capital in order to pay up the taxes. And there are many companies operating in Nigerian space with little margins. If you take the downstream petroleum industry as an example, or the electricity industry, those are, or trading generally, those are low margin industries. So that was welcome, so that their taxes, the taxes that they're paying, is not so onerous compared to high margin companies where they're able to pay taxes based on their profits. Other things in terms of equity, I think in a tax system, that the tax system needs to focus on is to ensure that everybody pays their fair share of taxation, and not just the people that have been paying it all the years, but other people who have been evading or are outside the tax net. They are brought into the tax net, and they contribute their fair share. I would say, some of the innovations that the Finance Act is trying to bring about, like the use of technology, will try to address that. But if you ask me as a stakeholder in the tax industry about whether this has been achieved, I would say to a large extent, no. What we are still seeing in the tax ecosystem is that the companies that have been paying taxes, the employees that have been paying taxes, those are the ones that are still contributing and driving the contribution to the tax to revenue, tax to GDP ratio. So a lot needs to be done in order to improve equity from that perspective and ensure that, those who are outside the tax net are brought into the tax net. And that brings me to the third bit, which is around revenue generation. So when you look at the tax to GDP ratio in Nigeria is about 6%. To grow that, it means that, there are a lot of players in the economy driving that GDP who are not contributing from a tax perspective. And I think, the innovation around use of technology, whether it be proprietary or third party, trying to identify taxpayers, that would, drive a lot of the improvement in tax to GDP ratio. But over and above that, I think, the government also looked at additional sources of revenue. For example, they now look at in the past couple of years, they introduced rules to tax foreign digital companies who do not necessarily need a physical presence in Nigeria to operate. They can have platforms or intellectual property or technology sitting outside the country, but generate a lot of revenue from the country. And the government has tried to introduce rules to tax those sort of companies in the past couple of years. And even in the current finance bill, there are proposals to actually even do more in that space. And I think overall, in terms of revenue generation, the finance bill has tried to supplement the efforts of the various tax authorities and also try to stimulate more revenue for government. So I think on those three objectives, the finance bill, finance act process has not done badly, but of course there's room for improvement.
Thank you, Kenneth, for that expose that you gave us. I needed to start that interview on that basis because we're not just having a 2021 finance bill, we've had it since 2019, at least a new introduction from this administration. I want to ask this question, why is it called 2021 finance bill and not 2022 finance bill, since it's accompanying 2022 appropriation acts? Because you would even see some people will write, even in newspapers, they don't know what to write. Is it 2022? Is it 2021? What was actually written to the National Assembly, I think, was 2021. But why shouldn't it be called 2022 finance bill? Bearing in mind that once it is passed and everything is okay, the president would sign and it becomes an act in 2022.
Yeah, to be honest, I don't have the answer to that. I think it is just the fact that the process for the proposal and the finalization of the process happens a year before the fiscal year, which the finance bill is supposed to support. So I don't think it is actually by design that the Finance Act 2019 is now giving effect to from 1st January 2020. So it sort of seems like, it is on a subsequent year basis that it's applied, even though it's named, it carries the nomenclature of the year before. So I don't know if it's by design or whether it is intentional, but I do agree with you that for some, it therefore creates a bit of complication because they have to remember that the Finance Bill 2020 or Finance Act 2020 is for the fiscal year 2021 and so on and so forth. To be honest, I think, since it started that way, the government has not changed it because the first one was Finance Act 2019, but it was supposed to support 2020. But if you rename it now, you would create a problem because we already have a Finance Bill Finance Act 2019, Finance Act 2020. If you go and call it 2022, it means that you probably skip 1 year. in terms of the nomenclature. But I do not think that the naming for me is really a problem. I think maybe, if the stakeholders are listening, they could ensure that it catches up with with the Finance Act, with the Appropriation Act 2022, and then just call it Finance Act 2022. That would create a bit of alignment and stop some of the confusion that people have when they are referring to the Finance Act. So I do not have an answer for you, unfortunately. I think it's just something that happened not by design, but from serendipity.
Kenneth, you tried. You did. Your explanation is just it, and perhaps you've also offered a solution to the federal government or to the Ministry of Finance. I don't know if what you said is really accurate. I don't know if it's by design or by serendipity, just like you said, but I guess they're watching, and if necessary amendments is to be done, they will do it to avoid that complication or confusion. Now let's break this into let's break it down. The 2021 Finance Bill. What are the things that this proposal is seeking to amend?
Hello, Nancy.
Yes,
Are you still there?
Yes, I'm here. Kenneth, can you hear me? Can you hear me now?
Yeah, I can hear you now. I can hear you now.
Okay. I asked, what is the 2021 Finance Bill? What is this seeking to amend? This proposal. Let's break it down.
Well, there are a lot of things. I'll start one after the other and see how far we can go, because there are a lot of proposals in there. One of it is targeted at lottery and gaming business, and it's seeking to ensure that lottery and gaming businesses are taxable under the Companies Income Tax Act. And the reason for this is that, historically there's been some ambiguity on how you tax betting, casinos, slot machines, bingo.
Oh, okay. It seems that Kenneth is gone there. Let's try to reconnect with him again, and we will be right back as we continue our discussion on the 2021 Finance Bill. Let's quickly take this break. We'll be right back. All right, welcome back to the program. Kenneth Erikume, tax partner, tax reporting and strategy, PricewaterhouseCoopers, known as PwC, is still with me here. Kenneth, just before we went on the break, I did ask you about breaking down the components of this finance bill. You were on that before the thing went off.
Yes, yes. Thanks, Nancy. So I was talking about the introduction of um, compulsory taxation under the company's income tax for lottery and gaming type business. So covers sports betting, bingo, any form of game of chance. And the reason for that introduction is that historically there was some ambiguity in the law introduced by the National Lottery Amendment Act 2017. And that act introduced a tax, a lottery's tax of 7% of the net revenue of um, people in the lottery and gaming business. And then it said that if you are taxable with this lottery's tax of 7%, you are then exempt from company's income tax and value added tax. So most of the big operators in the gaming and lottery industry never really applied this law because the FRS themselves never supported the law. However, some of the smaller players, especially in the slot machine and and those smaller operators, applied the provision of that Lotteries Amendment Act 2017, which meant that they were then exempt from CIT, companies income tax, and VAT. So what the government is trying to achieve by this proposal is to make that provision for that lottery's tax redundant and insist that everybody will be taxable under the Companies Income Tax Act. And by implication, if they have VAT liabilities, then they would also have VAT compliance obligations. So that is one of the introductions, which would impact on sports betting, lotteries, casinos, and so on and so forth. The other thing that the Finance Act also sort of tries to introduce, is a capital gains tax on disposal of shares. For many years in Nigeria, there was no capital gains tax on disposal of shares of companies, of Nigerian companies. And this made Nigeria quite attractive for investors who were looking at capital appreciation, not necessarily getting their return in the form of dividends. So they essentially come, make the investment, incubate the company for a bit, and then after maybe 5, 10 years, they exit and sell the shares, and they make their return from capital gains. Unlike many other countries that impose CGT on disposal of shares, Nigeria did not have any CGT. So what they are introducing now is a 5%, or proposing now is a 5% CGT on disposal of shares of Nigerian company, as long as the proceeds from that disposal is more than 500 million naira. So that is another introduction that they are trying to bring. Another thing that I spoke about the fact that in the past couple of finance acts, the government had been trying to tax foreign digital businesses. One of the concepts it introduced then was the concept of significant economic presence, that companies in that digital space were going to be taxable to the extent that they have significant economic presence, and profits can be attributed to that significant economic presence. So this created a bit of subjectivity and difficulty, because that is not the traditional way in which you determine nexus for taxing a foreign company. So companies were struggling on how to allocate profits to that significant economic presence. So one of the things, and this would therefore mean that companies would be inconsistent in terms of their approach to determining the profits. So what the Finance Bill 2021 is trying to introduce is that the tax authorities is trying to give powers to the tax authorities, which is the FRS, to assess such companies on a fair and reasonable percentage of their turnover, as a if and this will be in cases where they determine that the profits that those companies are declaring is not reasonable. Some other introduction, especially around um, the public sector space, was that or is number one, that if you are a ministry, department, or agency of government, any revenue that accrues to you must be paid directly into the TSA. Um, so the gross amount has to be paid directly into the TSA and not a net amount or an amount after deduction. So the full gross has to be reported. And this helps the government in terms of transparency and visibility of transactions, such that they're able to ascertain what the revenue of that agency or ministry is, and then determine whether those MDAs are being run efficiently in terms of their cost. Public sector is that in the Fiscal Responsibility Act, it allows the government to borrow for critical infrastructure projects, or where there is a project that has national impact. Before now, it was not possible for state governments, especially, to access borrowing in that form. So those are some of the introductions that have been introduced by the Finance Act. There are some additional components that it has introduced. For example, there is one that it's trying to correct with regards to the Petroleum Industry Act. So the Petroleum Industry Act introduced for the upstream petroleum operators the possibility for them to be taxed under hydrocarbon tax.
Okay, Kenneth.
And companies' income tax.
Kenneth,
but in the company's income tax, there's an exemption for companies that are involved
Kenneth, can
in
you
exports.
Hear me?
So when they export their goods.
Okay, Kenneth, if you can hear me, we will continue this program, but right about now we're going for a live broadcast, and
to rely on that incentive, which will be available to other companies. So if you're in the upstream, midstream, or downstream petroleum sector, and you're involved in exports, you will not be allowed to benefit from that incentive, which is available for those who export their product. So those are some of the examples of the changes that are being proposed in the Finance Act. I don't know if this is enough, because there are others, and if I have time to also touch on the others.
Yes, Kenneth. I know there are a number of them, about 12 laws to be amended. I think you've done about 6 or so. But let's quickly let's quickly interrogate some of the ones you have talked about, especially, like, let's take a look at the foreign companies components, the implications for foreign technology companies. How do you think that digitization has really changed the tax rules? That's the A part of the question. The B part of the question is, if you take a look at this now, if this passes through the National Assembly, that means that the tax burden will be shifted. That's talking about foreign companies now, or the payment of digital taxes. The tax burden will be shifted to consumers and end users. How do you think this is going to play out, especially for companies like Facebook, Twitter, AliExpress? You're doing adverts online. How can they really track that, for example, an advert is coming from Nigeria, or an advert is being watched by Nigerians, and they need to track that to pay taxes on VAT and all of that? Give me a sense of how this will work, and how digitization has indeed changed tax rules, or making tax authorities to be innovative as fast as tech companies are?
Okay, thank you very much. So I think you know, globalization and the trends in terms of industrialization shows that now we are in the information age, which essentially means, I mean, if you remember, there was a time businesses were done, you know, with carts and horses transporting goods across regions, and then we invented the, you know, ships, and then we invented aircrafts, and then the tax laws were developed to actually deal with those sort of transactions. The last set of tax laws were developed as old as 1920. The principle, which is what we call the fixed base or agency permanent establishment principles, which the OECD has been championing for many years, were developed in 1920. And so when all these companies, which, I mean, if you're following these companies, they are big and they're global, and in terms of market capitalization, they do way better than your traditional brick and mortar type business. So these companies operate everywhere across the world, but they could just be sitting in one country and be operating using a platform. And countries across the world struggled to introduce rules or laws to tax them. And you know, the OECD has been working on something which is called the inclusive framework, which is to look at a global solution to taxing these sort of companies. Because it's one thing to introduce a tax rule in your country to tax them, but it could create double taxation, which could erode their profits. So a global solution was, was being worked on, and is being worked on by the OECD as part of the inclusive framework, and what we call the base erosion and profit shifting initiatives of the OECD. In recent time, they've signed about more than 136 countries have signed up, to a solution called Pillar One and Pillar Two, which introduces rules on how these companies will be taxed across the world. Interestingly, in Nigeria, even though we were part of the inclusive framework, we did not sign up. We did not sign up to the inclusive framework. Sorry, we did not sign up to Pillar One and Pillar Two solution, because we already have the significant economic presence concept. And the reason why we did not sign is because there are thresholds. There are thresholds in the Pillar One and Pillar Two solution. So in Pillar One, the companies that are within scope have to have an annual turnover of more than 20 billion euros, which, if you look at the companies that would qualify, that would just be about 100. And then there are also profit thresholds. When Nigeria looked at that, that would be, limit the scope of how many companies we can tax to about 10. So Nigeria, essentially did not want to sign off to that, and we are continuing with our significant economic presence order concept. But in addition to that, so that concept is used for companies' income tax. It doesn't deal with the issue of indirect tax, which is VAT. The issue with VAT is that many of these digital companies, they operate a B2C business model. So they're not providing their products to businesses, but they're providing their products to individuals. So for example, your video streaming, or your adverts, as a sole proprietor on an advertising or social network site. So those sort of transactions, in our VAT Act previously, there was no way to collect the VAT on such transactions. So what the government has now done is to say that any supply by any foreign person to a Nigerian customer, that there will be VAT. And the primary obligation to collect that VAT sits with that foreign person. So this essentially means that the examples you gave of those foreign companies that operate in the digital space, they will now need to charge Nigerian VAT on their products and services to Nigerian customers, and primarily be responsible for collecting the VAT on those transactions. It would therefore mean that some of the things we enjoy in terms of video streaming or online music and those sort of things, they will now be 7.5% more expensive because VAT will now be charged on them going forward.
The
And those
question,
will be
Kenneth, is
collected by the foreign
how would they
digital
now remit?
companies, who will then be required to remit it
Okay.
to the FRS.
Okay.
Now,
okay. Okay.
inadvertently, they've introduced, sorry, maybe I should pause here.
No,
If you
no.
have a follow-up question.
Yes, you almost said it, because now for those companies, they are going to charge 7.5% on their products. My question to you was really, how would they remit it to the FIRS? How? Will there be a system in place that they can remit it to the FIRS? And how would the FIRS know that such transactions are on, so that they can also track it and know even the right amount of 7.5% of VAT that have been collected to be collected? Yes, VAT that have been collected to be paid.
All right, thank you very much. Now, that's a very, very interesting question. There are going to be two sorts of companies profiles you see in this space. The companies you mentioned, I don't want to repeat their names. There'll be the companies with good corporate governance, which means that anywhere they operate across the world, they comply with the rules and regulations in any market, that they have a focus. Now, for those companies, they already have sophisticated mechanisms of tracking, the countries that they operate in and where their customers are based. Now, for those companies, they don't have any incentive to evade tax. The only thing they want is that whatever they are doing has to be applied uniformly, so that from an equity perspective, the tax regime is equitable and does not discriminate against them. So that's the first bucket. I don't think FRS needs to be worried about those sort of companies, because they will declare and show you they have robust systems of identifying their customers through through a customer validation process, as well as the ISP address of the customer. So it's robust.
Okay.
Now, then there's the second sort of companies that do not want to comply, and do not see a reason why they should comply. Now, those are the ones that the FRS needs to be worried about, because those companies, because they are sitting offshore and outside the shores of Nigeria, number one, the government will struggle to enforce against them. It's difficult to move from Abuja and travel to another country to begin to follow up with those sort of companies. So if those companies decide not to comply or not to disclose the full information of their sales to Nigerian customers, the Nigerian government is going to struggle, which therefore means that the Nigerian government, the tax authorities, need to invest in technology and infrastructure in order to be able to identify those transactions that are happening within the Nigerian ecosystem.
Okay.
And not just to identify, but also to track and collect immediately those transactions. And I think the tax authorities are actually looking at, you know, solutions. They've done some pilots with some industries in the past where, you know, they would then plug what we call electronic fiscal devices to the point of sale of specific taxpayers in order to be able to identify how much sales is going through the points of sale and then determine the VAT that is applicable.
Okay.
So,
Kenneth.
The other thing government...
Kenneth, if you can hear me, I'm afraid this is where would wrap up today's program, but I can tell you that you'll be back here again because there are a lot of things for us to break down. Kenneth Erikume is a tax partner, tax reporting and strategy at PwC. Thank you, Kenneth, for joining us. And that's the end of the program today. Please be the best you can be and not a change that you want to see. I am Nancy Naji. Bye now.